Hello everybody, Mike Nelson, CEO, Efficient Lending Incorporated, with a timely topic, an important topic, especially with rising interest rates. Discounted mortgage points explained. All right, what are discounted mortgage points? Well, when you pay points or pay a discount, what's happening is you are giving the lender, the mortgage lender, money, and in exchange for that money, the lender's giving you a lower interest rate. So you can pay a discount and get a lower interest rate, as opposed to a par or a par loan, in which you're not paying for a discounted interest rate, nor are you receiving a credit in exchange for a higher rate. So you're really going to do one of three things when you get a lower mortgage priced to you. You're going to receive a credit from the lender in exchange for a higher interest rate. You're going to get a par loan or a par rate, which is even money, or you're going to pay discount or pay points, in which, in exchange for you paying the lender, you get a lower interest rate. So then that, of course, begs the question, how do you evaluate if paying points is a good idea? So discount mortgage points explained. I look at it really in two ways. First, I'm going to calculate if I pay points, how long is it going to take for me to recoup that money that I've paid out up front to get the lower interest rate? And, it's going to be a number of months, years, etc. So what most people do is they'll say, okay, here's my monthly payment at a par rate, and here's my monthly payment with the lower interest rate, so you're going to get a lower monthly payment. And so you calculate the difference between those payments, divide that into the points that you're paying, the money you're paying, and then that tells you how many months it's going to take to recoup your money. The problem is that's really flawed thinking. It's really not the best way to figure that out. And the reason is this. By definition, when you pay points, you are financing that money. You're adding to the principal of your loan. So what you could do, instead of adding to the principal of your loan and financing at a lower rate, you could accept the par rate, and instead of paying money out, add to your down payment. So let's say, a discounted rate costs $2,000 in points. Well, you could borrow $2,000 less, pay yourself $2,000 more in the form of down payment at a higher interest rate. So when you do that, we calculate the difference in those payments, and that's actually the amount of time that it's going to take for you to recoup that money. Now, so the question then becomes, what's better? Financing a higher amount at a lower interest rate, or financing a lower amount at a higher interest rate? So the second way I evaluate is paying points a good idea is I actually calculate the principal balance remaining on the loan at years 5, 7, and 10. I'll do that for the discounted loan, i.e. the loan in which you're financing more at a lower rate. What's the principal balance remaining on that loan at years 5, 7, and 10? And I'll calculate that same principal balance remaining on the loan for the loan in which I'm financing less at the higher rate. I'm going to compare those principal balances at years 5, 7, and 10, and whichever has the lowest principal balance, and you'll be surprised, a lot of times it's the lower financed amount at the higher interest rate is going to give you the lower principal balance at years 5, 7, and 10. Why is that important? Well, the less you owe on that loan, the more you own in your house. So if you sell your house, if you refinance your house, you have less debt to pay off. You own more. Here's the thing that mortgage companies don't necessarily tell you. It's a virtual statistical certainty that the loan that you have on your home is going to be retired. Either you've sold the home or you refinanced it somewhere between years 7 and 10. And they know that when they price the loan to you. So when you do the math, a lot of times you're actually going to own more home by financing less at a higher interest rate. Not all the time, but it's certainly worthwhile doing the math. So those are the two ways I calculate, is mortgage discount points or paying points advantageous? How long does it take to recoup the money? Number one. And number two, how much of my house am I actually going to own at years 5, 7, and 10? And then we just look at those numbers, look at those comparisons, and the borrower ultimately decides what's the best solution for them. All right, I hope that helps clarify what paying points is all about. I know it's a little bit confusing, and there's probably a lot of questions, so call me anytime. We'll love to continue the dialogue. Thanks for checking out my content online, and I wish you the greatest of success.